Good morning, everyone. My name is James Malliaras, and I'm one of the senior financial planners at GFM Wealth Advisory. A warm welcome to all our GFM clients and guests joining us for this morning's webinar for an update of one of our favourite unlisted property funds, the Charter Hall Direct Office Fund. We're absolutely thrilled this morning to have Stephen Bennett joining us this morning. He's the CEO of the direct property business within Charter Hall. I'll talk a little bit about Stephen a little bit later on. For us at GFM Wealth, we think that commercial property plays a pivotal role in the diversified portfolio with medium to long-term investments, giving our clients exposure to quality properties. With over 30 years of experience in property investment and funds management, Charter Hall is one of Australia's leading fully integrated property groups with a total property portfolio of over 45 billion. 2021 for us has been a very busy start. You've probably been to a number of webinars already. This incredibly is already our 5th webinar for 2021. Our clients have told us that they really enjoy them and they're very popular. And because of that popularity, we're going to continue to have a number of webinars like this planned throughout the course of 2021. We also hope later in the year to get back onto a face-to-face seminars. We were supposed to have one in May, but unfortunately COVID here in Melbourne stopped that. But look, keep an eye out for emails from the team at GFM to let you know when we're having our next face-to-face seminar. So before we get underway, it's important to understand that this morning's webinar is really about, it's general in nature and is not personal advice. Should you be seeking more detailed information in relation to your personal circumstances or anything to do with Charter Hall, please contact our office and one of the advisors will be happy to help you out. So once again, during the invitation process, for this morning's webinar, we did actually ask our clients who were attending if they had any questions. What we hope to do is actually, we had a look through those questions and we think there are any questions that we thought we could propose to Steve, then we've included it in our list of questions. So let me formally introduce Stephen. Stephen Bennett is the CEO of the direct property business within Charter Hall. In addition to overseeing more than $7.5 billion of assets on behalf of self-managed superannuation fund, SIV clients, high net worth and direct investors, Stephen manages a team of property funds management professionals who are responsible for the unlisted property funds across all of the real estate sectors within Charter Hall. His day-to-day responsibilities includes overseeing asset management and tenancy matters, managing the financial structure of the funds, stakeholder communications, and raising new equity capital. By speaking directly with investors, Stephen and his team are able to gather insights into the real-world goals that they hope to achieve. Whether it's regular income to support their lifestyle or provide better retirement, Stephen is driven by expertise, integrity, professionalism to realise outstanding outcomes. Stephen is an immediate past president of the Property Funds Association, a current member of the Property Council of Australia, New South Wales Divisional Council, and he's a member of the Australian Institute of Chartered Accountants. So he certainly knows his stuff very well. And so we're very fortunate to have him this morning. So Stephen, welcome.
Thank you very much, James, for that fantastic introduction. And I guess hearing all that about myself, I've already made a mental note. We need to give a much shorter bio. I'm sure you people and the audience here would much rather hear about today's information. And look, what I'm going to cover off today is really 3 things. I'm going to talk about the trends which we're seeing in the Australian commercial property space. I'm going to talk about how we managed through the COVID experience. And I'm sitting in our Sydney office, which is now my home at the moment. So it's still very relevant for over half the country which are in lockdown.
Yeah, I'm going to over 12 million people, I think, are sitting in lockdown at the moment across the country. So I just want to say, Stephen, our thoughts extend out to all those people currently in lockdown. Obviously, down here in Melbourne, we've been through it. We're pretty experienced. But look, our thoughts are with a lot of, for everybody up in north of our border, We do have a number of clients across New South Wales and Queensland, so our thoughts are with them.
Absolutely. And I'm also going to give an update on the key core sectors. So obviously the office sector, but also industrial and logistics, as well as the retail market and some things we're seeing there. And I guess probably most importantly, I'm going to give a little bit more detail on the direct office fund. I know many of you through GFM and some fantastic advisors there have been long-term clients in that fund. Look, it's in my self-managed super fund as well. And very recently, Charter Hall just increased its investment into the fund by putting $130 odd million into the direct office fund, which was done this month. So shows that alignment and also the commitment we have for the funds that we manage. So look, jumping right into some of the trends, and you can see here what these trends have happened through COVID. They're not necessarily new, but what they are is the COVID and the pandemic experience, not just in Australia, but globally, has accelerated these trends which were already underway. So e-commerce just has accelerated exponentially. If I look at my own personal situation, I've got relatives that have bought things online for the very first time, and that's an experience shared across a large number of people. You've got increased tenant demand for industrial and logistics assets, and that's been driven partly by e-commerce, but also by onshoring, as well as making sure that the stock and the capabilities there in the country. There's also been a negative impact on discretionary retail. So for all the positives that you hear about the industrial and logistics market, you need to think about the other side of that. So those sales which are now happening when I click a button on my screen aren't necessarily happening by me walking into a retail high street shop. So that's something we'll explore in a little bit more detail. The working from home experience, it's probably one of the most frequently asked questions I get in relation to the office sector. So I'll spend a little bit more time drawing out some of the considerations there, and I guess Charter Hall's overall view on that. And then there are some sectors which continue to go from strength to strength, being your Bunnings, your long leased healthcare, and long leased assets generally have continued to perform very strongly. So what did we learn through managing commercial property? So managing office assets, industrial and logistics, and retail centres through the pandemic. Well, despite Charter Hall's significant scale, in fact, just Friday, we released our latest FUM numbers, which is a bit over $52 billion. I think one of the successes which we had was we moved very quickly to make sure that we continued to meet the tenant requirements, as well as providing additional information to investors and financial advisors. So what we did, we instituted some out-of-cycle independent valuations. We had everything valued at 31 December 19, again at 31 March 20, and again at 30 June 20. So we put that extra March revalues in just to make sure that people understood the values and where they're sitting. On the transparency side, we communicated more frequently, not just with our investors, but also tenants. And the tenant focus really flowed through in everything we did. So because this was an event which hadn't happened in 100 years, a global pandemic, we needed to hold the hands of many of our tenants, big and small, to help them safely and efficiently get back into the office properties, the industrial sheds, and the retail centres. So we had people on the ground making sure that we gave them manuals, we helped them arrange additional cleaning requirements, provided them guidance on spacing and how we look at that. And above all, we stayed risk focused. We drew down our debt lines for all the funds to make sure that we had sufficient liquidity at all times. As it turns out, the banking sector stayed open and it wasn't required, but that is just a good example of how we're very cautious, and we are the custodians of other people's capital here. So we take that responsibility very seriously and remove as many of the risks as we can.
Stephen, just while I've got you on, let me ask, in relation to the tenant focus. So have you found that the needs and the requirements of the tenants, particularly around that commercial property and people working from home, has the needs of the tenants changed considerably over the last 12 to 15 months?
Yeah, look, James, that's a great question. I would say that I'd put it into two buckets. So the short-term needs absolutely changed around the extra heightened focus on health and hygiene. So at various points, we had to put thermal imaging in, so people's temperatures could be checked when they come into an office property, the cleaning, the extra spacing, that we've introduced non-touch door entries at various properties. So that's still something that's going through at the moment. On the long term, I think what you're going to see here is people still value very much the collaboration and the office space in terms of driving culture, better performance outcomes, risk management. But they also are aware now that they need to, if you weren't already providing your staff with flexibility, that is something you will need to do. So in terms of the long-term demand, we are seeing the work from home thing coming through with a lot of organizations. You will see more flexibility tenants want, and you will see some pushback as well, because as a landlord, we generally prefer longer term leases because it provides that longer term income streams for our clients. So look, it is still evolving. And you're also seeing, just in terms of a longer term trend, the densification. So how many people you fit on an office floor is slowly starting to reverse. The Sydney, Melbourne and major CBD markets in Australia are some of the densest office properties in the world. Obviously, you've got Hong Kong and some Asian markets, which are more dense. So we do expect that that trend will slowly unravel, and that is a reversal of something that's been happening for 20 years. Does that cover the question, James?
Yeah, well, thank you, Raj. That's very, very interesting. Very interesting. Thank you.
In terms of the relationship side, never forget that property is a relationship business. One of the things that really worked well for us, despite me sitting behind a camera today and presenting to you from Sydney, we do have a very substantial Melbourne office. We have a Brisbane office, a Perth, Adelaide. In fact, we have people located on the ground where we own the assets. So in a world of lockdowns and border restrictions, my office team right now are still negotiating leases, still having their coffee catch-ups with the tenants, meeting with agents, and that's something that a large-scale manager can do. And if you aren't in the local market, in my view, you're not managing the assets and securing the best assets you can. Active portfolio management, well, that's just a fancy way of saying, despite us having long-term leases, we don't sit on our hands and wait for those expiries to happen. We're constantly engaging with tenants. And a great metric around this is, before we went into the pandemic in December 19, the WALE, weighted average lease expiry of the direct office fund, was approximately 8.5 years. As we sit here now, a year and a half later, if we did nothing, you'd expect that lease term to wind down to be approximately 7 years. Whereas we're actually sitting, and you'll see it come through the slide later, still over 8 years. And that's because we actively extended leases, worked with our tenants, and we secured some fantastic assets in the pandemic because we had the capital to deploy and the underwriting capability of the group as well.
So Stephen, how you find the underlying demand there for office space? You know, obviously you've renegotiated a lot of deals, but is the demand still there overall?
Generally, if tenants didn't need to make a decision, they tended to defer them. That's a natural human tendency in periods of a lot of volatility and change. We still are securing very long-term leases for new properties. So they're ones being developed by Charter Hall or recently completed properties. So that is still happening. But it's really the secondary assets, the shorter term leases in quality, what's a nice way to put it? Assets that aren't the highest quality, they're the ones that are most suffering from the lack of tenant demand. But look, you need to also be honest with ourselves here. In periods of economic downturn, which has been the case through the pandemic, the office sector vacancy rates do increase. And that's something which we have seen happen in the short term. Fortunately, we entered the pandemic with some of the lowest vacancy rates in the Sydney, Melbourne market in the last 30 years, around 3.5% to 4%. And what you've seen is those vacancy rates, as we've came through the economic downturn and the disruption, have increased to approximately 12 to 13% for Sydney and Melbourne. And that is a natural tendency to happen. And the long lease that we have in place do give us insulation around that. So as the economic conditions change, we'll re-engage with tenants as well.
Very good. Okay.
And look, finally, so I should just say the returns and volatility, we all know what happened with the equity market. around Q1, Q2 last year. What I would say is the unlisted property, despite having those frequent independent valuations, didn't skip a beat. DOF continued to pay its distributions on a quarterly basis throughout all periods. And the valuations actually went slightly up at 30 June rather than down. And I'll talk to that in more detail as we progress.
So Stephen, from my point of view, obviously, we're going to go into a little bit more about specific about office. Our clients are still looking for income from their portfolio, and obviously Charter Hall's been a great source of income for a lot of our clients' portfolio, particularly those ones in the pension phase. How are yields at the moment from commercial and unlisted property? How are you finding those at the moment? Do they look still very attractive compared to other asset classes?
Look, it really does. And I think one of the best measures, which I'll talk about, is of all the office transactions which occurred in 2020 calendar year, so we've got very good data, 62% of the purchases were from offshore capital. So these are some of the largest wholesale investors in the world, sovereign wealth funds, pension funds. And James, part of the reason why they're looking at typically the gateway cities of Sydney in office and Melbourne in office is because they are looking at exactly that. The yields which they can get in these markets are very attractive on a global scale. So they're saying, well, I've got X amount to deploy. I can put it into Paris, London, New York, and they're still choosing to put a significant allocation into Sydney and Melbourne for exactly that reason you said. You can still get a fantastic yield. And because debt continues to be very cheap, that extra uplift you get between the yield on the property versus your cost of debt is significant, meaning that from quality office assets, you can generate a 5% plus income return, as well as a potential for the capital growth as well. And look, that's probably best shown here on this slide. The blue represents markets throughout the world. What's the nice way? The brownish color represents the Australian CBD markets. And the bottom of each bar shows the cost of debt in each market. And the top is the actual average property yield for prime office assets in that market. And remember, prime is just a fancy way of saying the highest quality assets. So well located, typically newer build with very strong tenant covenants. And that's the area which traditionally Charter Hall very much focuses on. So this spread between the cost of long-term debt, and we're talking 10-year debt, versus the income returns you can get from office assets across different markets is very attractive. The next slide also shows it graphically, showing the range is the length of the bar, the 10-year average is the cross, and where we sit currently. And remember, the bigger the spread means the greater yield differential, and theoretically, all else being equal, the more attractive office assets are relative to the cost of debt. And you can see here in all markets except the Adelaide market, the current spread is higher than it's been in the last 10 years. So this would typically lead to cap rate compression, and property moves just like a bond. So as cap rates go down, the value of the assets goes up. And look, I do want to stress, I'm not saying please factor in significant capital growth. I'm never one to predict the future. But what I am highlighting here is that the fundamentals around the cost of debt and the yields you can get on property in the office space are very attractive. And the Sydney and Melbourne markets in particular are very attractive on a global sense as well.
It's very impressive, Stephen. I think a lot of our clients would be looking at that and their aim of generating a good yield out of the investment. That looks very impressive. Which provides a bit of a segue, I suppose, to the Charter Hall Direct Office Fund, which we've got a lot of clients in. Can you tell us a little bit about a bit of a summary about that and where things are at the moment?
Absolutely. So look, it's a very significant fund, approximately $2.6 billion of assets. The occupancy rate is very high, and we love high occupancy rates. It just means it's more income that we can pay through to the investors in the fund. Having a 98% occupancy rate is something we work very hard at. You heard me earlier say that the typical vacancy rate in Sydney and Melbourne is around 12 to 13% at the moment. So we are significantly outperforming the market in that. And it's part of the contributing reason why the distributions for DOF continue to move forward. We did just have a board meeting yesterday, and the expectation is that current 8.5 cents per unit distribution rate will increase starting from 1 July next year. But look, I just encourage people to keep an eye out for our June quarterly update, where we'll actually make that formal. And the 8.4-year weighted average lease expiry, it's something you'll see across all Charter Hall's funds. Whether you're a billion-dollar sovereign wealth fund who's invested with us, a North American pension fund, or an investor who's put 20,000 of their self-managed super fund, we like to focus on those long-term leases because it does give our clients that secure income. And we know in a world where term deposit rates and bank rates continue to be very, very low, if not zero, being able to get that 5% plus income from core real estate is very attractive to a large number of our clients. It's also important to understand what's potentially coming up. So this slide on the screen shows the expiry profile across DOF's 80 or so tenants. So this is a weighted average of where all the expiries kick in. And we should also mention that leases across the portfolio are binding legal contracts. They also benefit in this country, a bit different to a lot of parts of the world. We've typically fixed rental escalators that kick in every year. So for DOF, it's around 3.7% annual increases across the leases. And you can see here, we've only got 2% vacant currently. And over the next 4 or 5 years, a very low proportion you'll see in those first years of leases that actually come up to expiry. And what I'd add is that it's typically even lower than that. Because of that active property management, having those staff members located on the ground where the assets are, we always engage with our tenants early and we try and do win-win deals. So I'll give you an example. During the pandemic, we had a tenant that required some additional capital to make their office safer. They needed to space out their computers more. They wanted some extra sanitization, some extra meeting rooms, and they didn't necessarily have the operating capital to do so. So what we did in that scenario was we provided that capital to the tenant. They were very happy. And in exchange, they were willing to sign an increase in the lease term of 2 years. So that meant not only did I have a happy tenant, but I had a more secure income stream for the long term. So that's a great example of how we work with our tenants and we focus on that active management. We don't just wait to the lease expiry before we call them up and try and do a leasing deal. One of the real strengths of a diversified fund like DOF is it's not beholden to one asset or one market or a single tenant. And look, don't get me wrong, there are some fantastic single asset syndicates out there. We've run a number of ourselves over the years. But one of the risks with those is that even the best manager, things can happen outside of your control. So if you have a tenant that was to go bankrupt, say Virgin Airlines, and that was a single property syndicate, you had the risk there with around the income. Whereas if that asset was a part of a bigger diversified fund, yes, you get a negative impact, but it still means you continue to pay distributions and the movement in capital value is very low. What you'll see here is the top 5 tenants make up 2/3 of the income. And this is something we've worked very hard at over a long period of time. And pleasingly, the biggest tenant or group of tenants is federal and state governments. And why do we like them? Well, we like them because regardless of what's happening in the world, because of their standing, their credit rating, they continue to pay rent and they're the most secure tenant you can get. We then worked through Western Sydney University, which is a very land-rich university, had $1 billion of net assets last time we looked. And the most recent credit rating they had is actually a higher credit rating than the big 4 banks in the country. Then you've got
on Western Sydney University. Was there any fallout, obviously, from many of the uni students staying at home? Has that had an effect on the university or the space that they need or anything like that?
Look, it's obviously been a headwind for them in the short term. So Western Sydney University has one of the lowest international students proportions compared to, say, some of the big universities like Melbourne University, Sydney University, New South Wales University. but they were absolutely impacted, James. But what they've done is they've looked at it as a short-term impact. They know the borders will open up at some point. The students will come back. Before the pandemic, education was Australia's third largest export. So I always think of it as ice, iron ore, coal, and education. So that will come back. And we actually used the opportunity in another fund to pick up a university asset because we thought the pricing relative to the risks was very attractive. And I guess just to round that out, they haven't handed back or wanted to hand back any space in any of the assets that they've leased in DOF as well. And then you've got Coles and Westpac sort of rounding out the top five. And someone said to me, well, what happens if they go broke? My common answer is forget what happens in DOF. Australia has much bigger problems. And I suggest your portfolio will have much bigger problems if any of those tenants hit the wall. The nice little pretty picture of Australia shows how we've purposely weighted the portfolio to the Eastern Seaboard market with a focus on the two largest global gateway cities of Sydney and Melbourne. And the average portfolio asset size is now a bit over 270 million. So what we've been able to do here is we've been able to provide our retail, our SMSF and high net worth clients access to the quality property that you typically need to be a wholesale investor to access. So that's where what we like to do. We believe in always, regardless of the equity source, providing that institutional grade property, but in this case, we're just making it available to a different group of investors. And here's some little pretty pictures of some of the assets you can see here. That first one with the soccer ground on the top of the roof is 105 Phillip Street. No, it's not a doctored image. That really is a football field. And look, it's a good point because the ESG, the environment, the social and the governance continues to increase and has increased dramatically through the pandemic. So having these extra facilities and services is very much valued by our tenants.
So a little bit one down the bottom right-hand side. So with the Coles building, Toorak Road in Hawthorn East, 50% owned by DOF. The other 50% is owned by the tenant?
No, it's owned by EPC. It's a private investor. So look, without giving away too much details, they're a Melbourne group manage some money on behalf of a local billionaire. So
and how do you manage those sort of joint ownerships? Do you get, has there been any issues around those? Obviously, owning property 100%, you make the calls, but owning properties 50% with another entity, has that been any issue?
No, look, there hasn't been, but it's a very good question, and you need to pick your joint venture partners very carefully, because if you get a misalignment around long-term objectives, that's where difficulty happens. And I have seen this in a past job where one owner particularly wanted to knock it down and thought the highest and best use was a residential tower, and the other owner wanted to do a long-term lease extension with a sitting tenant. So fortunately, we're very aligned. For typically, though, across Charter Hall, where we own assets in 50%, the vast majority of them are other Charter Hall managed funds. And that's because, as I said, the focus on the quality of the assets, the lease term and the tenants is something that's consistent across the group, regardless of the equity source. So we haven't had any issues, don't expect to have any. We've got a very good working relationship. The team that manages that is down in Melbourne, and we meet up with the joint venture partner face-to-face on a monthly basis as well. So look, how has the fund performed? Well, it's something I'm very proud of, to be frank. The team have worked very hard, and I can't take credit for this. Whilst I head up the business, it's off the back of the hard work that the asset management and property management teams do, the investment specialists and the acquisition team, as well as specialists in treasury, negotiating some of the best debt terms in the market. And you can see here, the last 12 months is 9.3%. Importantly, that's to 31 March. That does not reflect the 30 June independent valuations. I unfortunately can't give you any color on those. It is 30 June today, so that information isn't public. But look, that's information I can pass back to the GFM team tomorrow. And what I would say is, across the office sector, you've seen two types of valuation outcomes. And this is based off published data that the REITs, so the listed property groups, have done. You have seen valuation softness in assets that entered the pandemic and continue to have elevated levels of vacancy, short-term leases, and that are secondary in quality. At the other end of the spectrum, long-term leases in newer buildings that are well located have typically showed some cap rate compression, meaning the asset values have increased. And that's largely because, regardless of whether you're an Australian or a global investor, sourcing those regular income streams are very hard. So if you can get an office asset that has a 10-year federal government lease in a new building, those assets are very well bid and still very well sought after by a large number of investors across the spectrum. So look, keep an eye out for the returns, but you can see here across both the 12-month, 3-month, and since inception, the fund returns have tracked very well. And on the gearing side, we've continued to make sure that the gearing for all our funds that are open for investment sits below that 40% level. We think that strikes the right balance of risk and return. I could always increase the distribution rate overnight by pushing the gearing, but what that doesn't do is that wouldn't adequately reflect the risk that additional debt brings. So we're always striking the right balance, and I think good managers, and there are other managers out there who have done this very well, have stayed very disciplined. When your long-term cost of debt is the lowest it's ever been in the history of Australia, the temptation is to take on more debt because you get that benefit of the gearing even more so, whereas we've tended to stay very balanced in our approach.
So you've got a very strict discipline around the level of debt, because obviously, betting back at 12, 13 years ago, a lot of property funds out there that were highly leveraged, and during the global financial crisis, and valuations fell significantly. We saw, it was very difficult. You obviously deliberately keep that gearing level low, even though interest rates are at record lows, because you feel it's better to be prudent, even in a very low interest rate environment.
Absolutely. And look, it always rings in my ears, one of the founders of Charter Hall, who really instilled in me the importance of capital preservation. We know many of the investors in these funds may be retired and may not have the ability to recover any capital loss. So one of the best ways to preserve the capital is to be prudent. And James, you're right. Before the GFC, the discussion around gearing was very different. I would speak to researchers who would say, you've got a lazy balance sheet, why aren't you geared to 65%? Fortunately, those discussions don't happen anymore. It's really only the Asian and some of the global wholesale investors who are happy to gear things considerably, but they do that because they know they've got ready access to capital in the event of a downturn, so it's not an issue for them. But look, it is something that has stuck, whether it's the REIT sector or the unlisted sector. Most of the managers who went through the GFC and did it well have learnt the lesson around gearing.
Yeah, very important, I think, as well, too. I think we all saw what happened, and it makes us feel very comfortable that gearing level, is low. Although it can be high, it is low. And I think, and it's sense of comfort knowing around there. Look, very impressive returns, and a lot of our clients who are in this fund, have been impressed by the consistent returns in, year out. There doesn't seem to be a lot of volatility in the return, as you can see there. So, and the income's been great. So look, well done to you and the team. It's been a fantastic result over the last, 3 to 5 years, particularly. Stephen, in relation to, obviously we've covered very, heavily on commercial property. The other types of properties that we're also interested in, and as you bring up on the slide here, is around industrial, logistics, as well as retail. So can you tell us a little bit about your thoughts around those particular property sectors, where you're seeing, the issues, opportunities, and things like that?
Absolutely. And look, this is probably one of the easiest trends to talk about. There's 3 things that are really driving the demand for industrial logistics. The first is around e-commerce, which I mentioned earlier, and I'll come to a slide which shows just how dramatic that's been. And you can see up there on the screen, it's just a simple, not so simple warehouse, but the e-commerce story only works if you can ship the goods and get them to your consumer and the shops in a timely manner, in the way that the customer expects. So the level of tenant demand for the industrial and logistics space continues to exceed the 10-year average. This is probably the hottest sector in the world at the moment. The biggest challenge is sourcing quality assets and not overpaying for them. So at Charter Hall, that's something we do very well. We've got the largest transaction team in the market. So that just means we've got more people across the sectors scouring for the right assets. And it's meant that we've been able to do a lot of sale and leasebacks with tenants, and they typically do very long-term leases in that space, as well as through our relationships off-market with external sales agents as well. So what I will show is a slide around, this is a property where we're building for Coles. They've partnered up with a group called Ocado, which are doing automated goods shipping and delivery. So in this center, you'll see a whole bunch of little automated robots that sit above a hive structure. They're doing approximately 80,000 movements in terms of deliveries per week. And what you're seeing is Coles, Woolworths, and a large number of other large tenants are increasingly moving into this automation space. And it's something we want to stay very close to, because this is a key trend that's expected to continue, not just for the short and medium term, but also for the longer term.
So, spewing out more plastic everywhere.
So they almost look like small little photocopiers running around, but what they do is they drop down into that hive, pick up the goods, ship it. And as you can imagine, these kind of robots will work 24/7. They don't get sick, and can really give that economies of scale, which you really need to make e-commerce work. Because originally, your large Woolworths, Coles, supermarkets were really doing online shopping at a loss. And they need things like this to make sure that it does make economic sense for them in the longer term.
It's fascinating stuff, Stephen. Thank you.
And look, this is a nice slide that graphically depicts the impact that the pandemic has had on the demand for e-commerce. So the grey bit there is what was forecast to be the e-commerce penetration as a percentage of sales over the next 5 years. And the little orange uptick shows that, in effect, the last 12 months, we've pulled forward 5 years worth of e-commerce growth in a very short period of time. Importantly, it's also worthwhile noting where Australia sits in a global sense. We are well behind the e-commerce penetration in other major markets such as Europe, the UK, China, which last time I looked was about 29%, and the US. So if you believe the e-commerce trend will continue to grow, that is a real structural tailwind for the industrial and logistics sector in Australia. And look, it wouldn't be a market update without going through what are the impacts on the retail sector. So the major core real estate sectors in the country in the commercial space are office, industrial and logistics, and retail. And the first thing I want everyone to understand is not all retail is the same. We tend to think of it in Charter Hall as two different buckets. So you've got your non-discretionary retail, which is typically your supermarket anchored, Coles, Woolies, Aldi, and it may be a standalone supermarket or have a number of specialty, typically food shops hanging off of it. And at the other end of the spectrum, you've got your large regional malls. They used to be called fortress malls because people thought no matter what happened, the valuations and the income would be protected. But what these fortress malls or big regional shopping malls have in common is a large proportion of discretionary retail shops. This is the sector that's been most adversely impacted by the e-commerce trend, which I just talked about. So at one end, you've got your neighborhood shopping centers, Coles, Woolworths, who have performed exceptionally well through the pandemic. In fact, the investor demand for long leased assets in this space is extremely strong. You've had capital growth, cap rate compression, as well as a stable income. At the other end, the big discretionary retail malls have been the sector arguably most impacted by the pandemic. As I said at the start, the pandemic didn't necessarily create new trends, but what it did was it accelerated trends that were already underway. In these big malls, you typically saw valuations come off around 15%. And that's largely because not only have cap rates come out, but there's also pressure on the rents that these retailers can pay. So we don't necessarily think that it's reached the bottom yet, but at some point it will offer value more relative to what the risks are. And somewhere in between are your Bunnings assets. So there's a reason we've put the Bunnings up there. Arguably, it can fit into an industrial portfolio or a retail. I say both because they are typically zoned industrial. They are a warehouse by name, as you can see on the screen there, but they do serve retail customers. We think Bunnings are one of the best franchises in the country. They've got little to no competition. You typically don't have to pay tenant incentives, and they've got great underlying land value because of where they're located in close to population centres. So this is a sector we do really like. And again, a bit like the industrial and logistics market, which I talked about, the real key here is being able to access the assets and not overpaying. As the largest owner of Bunnings in the country, we do have a fantastic relationship with the tenant, and it means we get additional insights into how particular stores are trading and whether they're likely to remain in those long term. So look, that gives you a little bit of a summary. I love property. I could talk about the sector updates all day, but I know you're all time poor, and really what I wanted to do in that update is make it educational. This seminar, working with our friends at GFM, isn't a product flog at all. It's to really educate the audience, provide you with the latest information, and to provide that greater understanding, in the case of DOF, what your money's invested into.
Look, Steve, I think it's been fascinating. The information here has been great. I think it's been a really good summary. Most of us and most investors in Australia, really, when they think about property, it's really to do with residential, property. That's what people know. They talk about it at barbecues, and nobody really looks beyond that residential property. And so there's a whole array of really good quality properties that are just, beyond residential, commercial, particularly industrial, which really, has been in the background for many, many years. And I think the whole pandemic brought industrial property to the forefront. And obviously there's situations and properties like Bunnings. So it's a really good summary. And I think a lot of investors who really didn't know a lot about these particular asset classes, we try to educate them. And I think this summary brings a lot of really good stuff to the fore. I'm going to, before we finish up, I'm always interested for you to bring out the crystal ball, given how difficult things are. So I don't know, what are your thoughts about, obviously lots sort of pandemic based and nobody knows what's going to happen there. Who would have thought, we'd be in the currently situation we're at the moment, but what are your thoughts around, commercial, industrial and retail property going forward? Are there any sort of little bullet, little snapshots that you think we should be aware of?
Yeah, look, I guess the first thing I'd say is anyone that tells you they know the future definitively is lying to you. But with that caveat out of the way, I'll give you our best estimate and our views on the various sectors. So we very much believe that the office sector will continue to be the core part of most wholesale and sophisticated investors' commercial property holding. We speak to a lot of heads of property out there, CEOs, members of the C-suite, and by and large, despite some of the tech firms grabbing some headlines around saying they'll never come back, senior management want to get their teams back into the office as safely and as quickly as they can. So we do think that the working from home impact will, yes, it will impact short term, particularly as companies find the way to balance it. But longer term, if you've got quality real estate, it will still be the center of most organizations and the way they work. And that's because there's too many studies to count around collaboration, culture, risk, that really drive the business. And I would say the working from home experiment's shown that people can do it, but whether it's going to preserve value for those companies longer term, the best way I heard a CEO say it to me is, we've been eating down the culture that we've built up over decades, over the last 12 months. We've got people that have never met their colleagues. There's additional risks that we didn't see. So I would say for the office sector, be careful. We think the secondary assets, so the lower quality, do have the potential to be most impacted. And that's because the tenants that do want, for all the benefits to be in the offices, do want the extra features, the amenity, the breakout areas, the environmental credentials, and basically just a more pleasant office experience. In the industrial logistics space, look, our view is that this trend will continue. It's been led by tenants taking more space, but also investors who are typically trying to downweight out of that discretionary retail and upweight into the industrial and logistics sectors. That's not just an Australia trend, that's a global trend. 2/3 of the money Charter Hall manages is on behalf of Australian super funds and offshore pension capital. So we do get the insights into that offshore investor thinking. And so whether you're in Paris, London, North America, there is huge demand for industrial and logistics. And in the retail, look, if you can get your hands on a quality Bunnings, those long leased Woolworths, Coles, we still believe that they'll do very well. And we're not saying don't ever invest into discretionary retail. We're just saying we think that the valuation softness still has a little bit of time to go. But at some point, the risk and return metrics will make sense.
Very good, very interesting. Thank you for that great summary. There was a little one of the previous slides that you had about Amazon. I think Amazon are looking to bring all of their staff back. Is that right? Is that what your understanding is?
Yeah, look, that was the statement they said in April, which was around they want the office to be the center of what they do. The tenants' views have changed materially. I spoke to tenants in June last year that said, this is great. We're going to save a fortune on office rental. You fast forward 6 months, December last year, and they said, forget everything I said. We've got mental health issues with our team, communication issues, help us get our team back into the office. And look, there will be some tenants that it does work to be remotely based. But as another CEO said to me, some of the staff need to be very careful what they wish for, because if their job can be done solely remotely, isn't creative, isn't collaborative, there's no reason why it can't be outsourced to potentially a cheaper jurisdiction as well. So it's interesting. I think it's evolving, and the best defense we've got in the short term, because there is weakness around the office sector in the short term, is those long-term leases, meaning we don't need to be stepping into the market unless we want to, unless we can cut the right deals that make sense for our investors.
Fantastic. Thank you, Stephen. It goes without saying, being June 30, I want to wish you and all the team at Charter Hall a happy new financial year. It's been a really interesting year on financial markets across all different asset classes. Who would have thought we'd be where we are at the moment, given 12 months ago at the beginning of July how things were playing out at the time. But it's been a very interesting, volatile, in somewhat fantastic year on financial markets across all most asset classes. So good luck, and wish you and the team a great new financial year. We look forward to looking at some of those revaluations over the next couple of days. And also to all our guests and clients who jumped on board today, look, I want to wish them on behalf of the GFM team a happy new financial year starting tomorrow. We said we hope to be able to start to do some more face-to-face seminars later in the year.
Yeah, and look, James, I guess I just want to thank yourself and the GFM team for having me and giving me this opportunity to update your audience. It is something we do value very much. Call out to Paul Nicol, the managing director there, who was again nominated as one of the top Barron's advisors in the country. So The clients are all being very well served by James, yourself, Paul, and the wider team at GFM. So we wish you all the best as well. And please feel free to invite us back at a future point.
Thank you, Stephen, and thanks to all our clients and guests for today. Thanks.